What's going on, guys? Welcome to another video. Make sure to hit the like button and the subscribe button before we get started. And yeah, let's get straight into things. So today we're going to be looking at liquidity. Liquidity is one of those words, those kind of buzzwords that get thrown around the forex and trading space quite a lot. And I can understand how it can cause quite a lot of confusion amongst traders. But we are going to be looking at it in the terms of ICT concepts, as that is what I trade. And yeah, we're going to get straight into things. So ICT defines liquidity as being the open interest of buyers and sellers in the market, and he also explains that it is the willingness of buyers and sellers above and below market price. That can sound very confusing at first, but when we look at it visually, you'll be able to understand much more clearly as to what I mean. So above relative equal highs and significant swing highs resides buy stops, that's buy side liquidity, and below relative equal lows and significant swing lows, that's where sell stops reside and sell side liquidity. Now, what are buy stops and sell stops? Well, we can see these relative equal lows. We'll start with the lows here. We've got relative equal lows here, 1, 2, and 3. These levels all make up relative equal lows. So let's just draw that out. Let's get that lined up. And this gives us sell side liquidity. So I'm just going to mark that out. I'm going to make it bigger for us. So sell side liquidity and sell stops are what we anticipate to be resting below these lows. So whilst the market is trading in this range, and you see how we fail to take out this low here, and we fail to take out the low again here, a lot of retail and uninformed money, which is the people that don't understand ICT concepts basically, all of the uninformed money believe that this will now be a resistance level, which means that they are willing to then put their sell stops there. And what do I mean by sell stops? It's simply just a stop loss for their positions. So let's put sell stops or stop loss. These are all retail sell stops, or uninformed money, shall we say. Let's call it uninformed money. So we know that below these lows are going to be uninformed money, sell stops, and stop losses. So let's say I am uninformed money. If I believe the market is going to go higher, where am I likely to want to place my stop loss? I want to put it below a level that seems to be showing support. It's showing support here, so I may want to put my sell stop below this low, thinking, okay, it's going to continue to act as resistance, and then we can trade higher, assuming I am in a long position. With that in mind, what we need to understand is that price does not work like that. And then what actually happens, you can see here on the 7th of March, you can see our price aggressively runs down, grabs that sell side liquidity, all those sell stops and stop losses, and then we trade aggressively higher, and price runs on higher to another level. So what's going on here? Well, these sell stops are being bought by someone. So there's some kind of big money or informed money, so money that knows what's going on, which are buying all of these sell stops, because as soon as this candle here traded down, grabbing out all this sell side liquidity, all of these sell stops and sell side liquidity were triggered. So it caused a trigger for all the sell stops to come flooding into the market, which is where the liquidity is. And then what's happening is the big money is buying up all of those sell stops so that they can release their positions at a higher price. And that will be the formed money. So this is the people that are buying below these lows, below these relative equal lows. The people that are buying here are the informed money and are the smart money, because they know that they can buy these stops knowing that they can release them at a higher price, and knowing that they're moving the market higher. So what's happening? I'm just going to explain one more time. There's lots of uninformed money. Remember the majority of the market is of uninformed money. They have all their stop losses down here, which allows for which builds up liquidity. So when price does come down here, all of those sell stops are triggered, flooding into the liquidity, and then all the buying by the smart money starts to occur as they're buying back those stops. So a good way of looking at this is understanding that all of these sell stops need to be selling to somebody. So we want to be buyers of those sell stops. So as soon as price comes down, we buy, knowing that price is going to be moving higher. Now let's look at it with the buy side. So here we have two relative equal highs. That creates buy side liquidity. Why does that create buy side liquidity? The exact same reason it created sell side liquidity. And I'll just explain that now. So we've got buy side liquidity. Uninformed money will have their buy stops this time. And wow, yeah, stop losses again, or limits, stop limits even. All of the uninformed money will have their positions residing above the buy side, above these relative equal highs. So we're going to be looking at it the exact same way. So if, let's say I am retail again, but this time I'm short, I'm expecting the market to move lower. Yes, the market moves lower, but where would I want to put my buy stop or my stop loss? I'd want to put it above somewhere that's appearing to show some kind of support. Here, resistance, sorry. Here, we have this swing high, which fails to take out this swing high. So we have an illusion of resistance being shown. So I, as a retailer, may put my stop loss above there. The market does move lower, but then what happens? We turn around, and what gets swept? The buy stops. So the same thing that happens with the sell stops that I just explained now happens on the buy side. As soon as this trades through, liquidity flows into the market. All of those buy stops are now triggered. So who's going to be selling to these buyers? Because remember, there's going to be buyers above the buy side liquidity and there's going to be sellers below the sell side. So who's buying? Again, smart money. So I'm going to be selling to those buy stops because people are willing to buy at this price. And where would I want to offset my position? Again, below some kind of liquidity. And you can see we pull back into the range that we created and we swing back below this low and this low. Now it is very confusing what I'm going through, but hopefully this is a very, clear example of basically what buy side and sell side liquidity is. And what ICT concepts aim to do is to say that we should be pairing buy side liquidity with sell side liquidity, buy side liquidity, and buy side liquidity with sell side liquidity, because that is all the market does. It just pairs one to the other, back and forth endlessly. But as smart money, what we'd want to be doing is we'd want to be pairing that sell side liquidity with buy side liquidity, meaning we'd want to be buying as price comes down into those sell stops, knowing that price is going to offset those positions above the buy side. What would be a perfect trade here would be to wait till price comes down below these lows, buy at this level. As we sweep these lows, we can buy that. Let's make it blue. And then where would we want to let off our position? Well, we know we have relative equal highs up here. And what are resting above relative equal highs? Buy side liquidity, because the uninformed money are going to be putting their stop losses there. So we know that we can let off our position as soon as we trade up above those relative equal highs, and then we can get out of our position up here. Now this is, again, a very crude depiction of what liquidity is, but I do hope this has made things slightly more clear. I am going to show us another example, so stick with me. So here we are looking at Euro USD. And I can see another example of where sell stops are grabbed and then released above the buy side liquidity. So here we have some sell side liquidity. Why is the sell side liquidity residing below here? Because we have a swing low. We have two relative equal lows here. And well, depending on the time of day and things, we would be anticipating some kind of run or correction on stops. So you can see that price comes down, sweeps out the sell side liquidity. Let me just mark that out as sell side liquidity. And then what we are waiting for at this point is we want to see, is there a willingness for us to want to trade higher? Yes, we have that willingness here. Why? Price aggressively trades higher, comes down back into the breaker, and then where would you want to let go of those positions? Above relative equal highs. Where do we see relative equal highs? This high and this high, relatively equal, so we can mark that out as buy side liquidity. So let's write that out as buy side liquidity. And remember here, the exact same thing is coming. The exact same thing I explained earlier is happening. Price is coming down. Sell stops are being triggered. We want to buy those sell stops because we are smart money. So we buy. You can see we consolidate. And then we wait to see if there's a willingness to go higher. Is there a willingness to go higher? Yes. We can see price aggressively trades higher here. We have a breaker block here. But we can speak more about that in later videos. This will be a breaker block. You can see price comes down, trades into that breaker block. We could even, if we didn't want to buy as soon as we took out the sell side liquidity, we could simply buy on the breaker and put a stop loss below here. We buy that, and then what? And then we simply wait for price to run up and take out the buy side liquidity, which it does nicely over here. So I hope that makes sense, guys. I want to make clear that buy side liquidity resides above significant swing highs and relative equal highs, and significant swing lows and relative equal lows. My previous videos did explain this, but they were quite laggy, so I can understand if you struggle to understand what's going on there. I hope this video taught everybody something about liquidity and understanding the point of it. But although you may understand what liquidity is, or understand that it's simply just a rush, it's just a rush into the market. It's just a rush of orders that are coming flooding into the market that smart money is buying or selling. Although we understand that, we need to also understand that with ICT concepts, time plays a major role in how liquidity is distributed and attacked accordingly. So there may be relative equal highs residing above here, but we don't reach those highs until 1 p.m. And there's a reason for that. It's because the markets run on time and price. We'll speak more about time in upcoming videos, but make sure to leave a comment, subscribe and like, and let me know if any questions you have, because I'll be happy to answer them in the comment section. Thank you guys for watching, and I'll catch you in the next one. Peace.